Welcome to the Law Podcast, where the goal is to motivate, inspire, and share success principles. I'm your host, George Almasri. Welcome back to the show. Today I interviewed Dalia Barsoum, and most of you guys listening know that she's a seasoned mortgage broker with the Streetwise team. A lot of people have worked with her. And what's cool about this episode is we talked about what I'm sure a lot of you guys want to learn about, which is U.S. financing. So from my understanding, she's one of the first brokers in Canada that's going to be dedicating a division of her team towards helping people get financing in the U.S. specifically. So we broke that down. There's also a little bit of talk about investing in Alberta and how they're helping investors do that across different provinces like Nova Scotia and New Brunswick as well. We talked about CMHC. So most people have probably heard by now that if you have a commercial loan that's private, like a vendor take back or a private first, for example, on a commercial building, you can't take that loan directly to CMHC. They will not pay it out. So different strategies on how to position yourself to be able to refinance through CMHC. I know a lot of people are dealing with that on the commercial side. So there's a lot of good things for you here. The last kind of major point that we talked about was entering the housing market. So for any new investors that are listening that are looking to get their first property, there's some tips and pointers on how to do that. Hope you guys will enjoy the episode. The one thing I would like to ask of you, which I often ask, is to leave us a review. So anyone listening to this, if you can just go onto whatever app you're using to listen and ideally leave us a 5-star review, that would be greatly appreciated. That'll help us grow and get the message out there to more people. So please do that. And that's it for me. I hope you'll enjoy the episode. I'm here with Dalia Barsoum. Thank you for coming back. Is this the second time or the third time? I think third time.
I think it's the third time.
Third time, yeah. Well, it's great to have you back.
Thank you, George.
What's new with you?
There is always something new, which I'm going to talk about shortly, about the U.S.
That's been your focus, right? So we talked a little bit about what we're going to focus on today. So there's a couple things. We're going to, like you said, talk about U.S. financing, investing in Alberta. We're going to talk about entering the housing market for anyone who's looking to buy their first property. And we're going to talk about the OSFI regulations. Did I say that right?
Yes, OSFI.
Yeah, OSFI, yeah. Perfect. Oh, and also CMHC. So on the commercial side, if you have a private loan, what's the best way to get into a CMHC insured loan? So these are the kind of 4 points that we're going to cover. So why don't we start off by talking about entering the housing market? Yes. There's a lot of people right now that maybe are on the sidelines. They're waiting. They're not really sure if it's the right time to do it. Interest rates are a little higher. So what can we say about that?
Actually, I did look at some data because I was curious about why sometimes people sit on the sidelines when interest rates are high. Because in my mind, prices are lower and you have more power to negotiate right now compared to when we were dealing with lower interest rates and it was complete craziness. And I looked at the relationship between house prices and interest rates, I think for 30-something years. Compared the housing price index correlation to interest rates. And here's what I found. When the interest rates go up, house prices take a different direction. They actually tend to go down. And for every 1% reduction in interest rate, okay, ready? House prices tend to go up by about 5%. Mm-hmm. So right now, in my view, George, is a good time to enter the housing market despite the higher interest rate because there is a rate cut on the horizon. Of course, the magnitude and the timing may be questionable, but there is a good chance there is going to be a rate cut this year. So in my mind, for those who are looking to enter the housing market, you go in, you position yourself with either a 1-year fixed or a 5 years variable, and you write down the interest rate cycle and you're getting a house at a cheaper price, so your mortgage is smaller. The question is, how do you get over the hurdle around some of the qualification challenges and down payment challenges and affordability challenges? That's a question that I'm commonly getting right now. Mm-hmm.
So let me ask you a question. You mentioned going with a 1-year fixed or a 5-year variable. Let's say somebody goes with a 5-year variable, rates come down, let's say 2% in 3 years. And then all of a sudden there's fear that the rates might go back up again. They can lock in the rate, right, from a variable, or at least with most lenders, it's possible. Or on the A side?
Yes, you can lock for the remainder of the term.
For the remainder of the term. Is there a requalification process involved?
Not for locking, no.
Not for locking in. So then you would just go with whatever the current rate is. Like, how does that work? Let's say you have 2 years left, 2 years and 3 months left on your term. What rate are you locking in at in that situation?
You would be looking at probably the 3 years or 2 years. I'm not exactly sure, but the lender will give you an option to lock in for the remaining term.
Okay, so that's a good option for a lot of people.
Yeah.
So even if you have Prime Plus, let's say you have Prime Plus 0.5 on the variable side, you would still get the lower fixed rate, because usually right now the fixed rates are lower than the variable, right?
Right now, the fixed rates are lower than the variable, and also, but depends on the term. The lowest is the 5 years fixed, because it reflects a long-term view of where the rates are headed.
Yep.
1 year fixed are higher than the 5 year fixed, but the differential between a 1 year fixed and a variable is not that big. Okay, so yes, you're right. They are lower than a variable, and if you choose to lock, if you take a variable rate, you would lock in for the remainder of the term.
Yeah. And so basically, just to recap what you're saying, it doesn't always make sense to wait until the rates come down. You're saying it's better to take advantage of the lower prices, because as the rates come down, the housing prices are going to increase. So it might make more sense to just purchase now, and then, hopefully rates will come down and you'll just be in a better situation overall.
Exactly. And also think about it. When house prices go up, more down payment is going to be required, right? And you're going to end up with a bigger mortgage. So if you look at the life of the house, you have a bigger mortgage over a much longer time period versus taking a small hit on the rate right now, knowing it's coming down, in the near horizon.
Yeah. The other thing we were talking about is pooled equity ownership. So you're seeing more of that now, where maybe a brother and a sister will put their money together, or a cousin and an uncle or something, people are just pooling their money to purchase and get into the market?
Yeah, so I've been asked, what are some of the things that I can do to qualify better? And pooled ownership is one of them. I'll give you a quick rundown of some of the options clients are considering right now. So yes, coming together with other family members or a group to buy a house. So you qualify as a group. Everybody contributes their share and collectively qualify for the mortgage as, again, a temporary stepping stone to get into the housing market. Another option is to buy something with a finished in-law suite, right, that you can rent, because we can use the rental income to help qualification. A third one is considering rent-to-owns. So you're renting the house with the idea of buying it in 3 years, let's say, from now. You got to be very careful which companies to work with if you're considering a rent-to-own, but it is a good option as a stepping stone for those that may not have the full down payment today, or have bruised credit, or need time. And then lastly, down payment options. If there is a shortage in down payment, what do you do? And we're helping some clients supplement down payment, let's say, with unsecured money. Yes, it's going to cost, but if the client can afford the payment and the numbers still work from a mortgage standpoint, we can help them gather down payment that way. So these are some of the things, emerging themes right now for getting into the housing market.
So when you're talking about an unsecured amount, is that something that they would have to come up with on their own, like just get an unsecured line of credit or something and use that?
Yeah, they can either go to a bank for an unsecured line of credit, and also through us mortgage brokers, we can help them arrange unsecured loans. Obviously, we want to make sure the numbers work for qualification, and they can also afford that payment on the unsecured loan. Once the house appreciates, right, we can always refinance the house and pay off that loan.
And the unsecured loan, would that just be a temporary, like, couple months that it would be provided by yourself, for example, or is it like for a year or 2 years?
No, it's a loan that is open for repayment at any time whenever the client is ready.
Okay.
It does not have an end term. It's 2 years, 3 years, open for repayment.
Yeah, I was just thinking, renewal. When I first got started, like something like that would have been really helpful for me, because I had a bit of money saved, but I didn't have enough to get a full down payment going. So that could have been a really good option, because my intention at that time was to renovate the property and refinance it, right? So if somebody's doing that, it can work well.
Yes.
Yeah. What about, so we talked about this a little bit before we started recording, but what about buying a 4-plex, a 5-plex, or a 6-plex as your primary residence, as an entry to the market, buying it in your personal name and using the income from the property to help you pay your mortgage?
Yes, that's a really, really good one. It's similar to the idea of an income suite, but now you've magnified it by adding these extra units. Now, here's the thing with 5 units and 6 units, George, are considered commercial, with the exception of 2 lenders on the street that would approve them under the typical residential rules, which are RBC and Desjardins. And that income, although the units may not be rented at the time of closing, can significantly help somebody qualify, because the lender is going to look at what these units could potentially rent for.
Mm-hmm.
Yeah,
that would be a great option for some people, because first of all, you may not, I don't know the exact rules, but you may not need the full 20% down if it's your primary. We would have to confirm that. And then you would have, with RBC, a 30-year amortization potentially.
Yes.
And yeah, your cost of living would be pretty low, so it could be good.
Yeah, exactly.
Yeah. Okay, let's talk about U.S. financing, because it sounds like you're really excited about that.
Yes.
Every other person that I speak to on the podcast is telling me that they're either exploring U.S. options to get into the U.S. market, or they already have.
Yes.
So tell me, what are you seeing on your end?
So, we work heavily with real estate investors, right? And for investors who have been investing in Ontario, obviously, there's been a lot happening that has added up from tenancy rules to taxes to, Airbnb changes, all of the things that have been happening over the past year and a half, roughly. So we are seeing increased appetite for investing in the U.S. And there are markets in the U.S. where the tenancy rules are very decent. They're not anti-landlord. And also the yields are better. So the yield is the price to rent ratio, right? And there are states where a lot of great things are happening with respect to infrastructure expansion, employment, and all of that. So we're seeing a shift there. So what we're doing is we're always looking to bring options to investors. So in a few weeks from now, we're launching our U.S. financing to Canadian investors who are looking to buy specifically income-producing properties, residential or commercial. And George, I'm super excited about it because the thinking is very different. Just to give you an example, the qualification is primarily based on the property, okay? We can use Canadian credit. We don't need any extensive documentation to support income. It's based on the income of the property. You know how commercial lenders qualify properties? The ratio of the income to the expenses, debt coverage. It's exactly the same philosophy on a residential deal. And as the portfolio gets bigger, the investor gets better discounts. Where here in Canada, as the portfolio gets bigger, you know what happens? The cost of money becomes more expensive. The lenders start to cut down because they see it as a riskier deal. In the US, it's actually more entrepreneurial. So very excited to bring these programs over to the investment community in a couple of weeks from now.
Okay, I've got a couple questions on this. First of all, I don't know if you're even able to go into a little bit of detail here, but are you working with Canadian banks, Canadian institutions to do this, or you're working directly with U.S. institutions?
I'm working directly with U.S. institutions across 50 states who are offering programs specifically for what's called foreign nationals. So that includes Canadians as well as others across the globe who are not necessarily U.S. citizens who are looking to buy specifically income-producing assets. Here in Canada, if you're to go to RBC or TD or BMO, they've got branches in the US, but they would actually be a good option if you're buying a second home. But if you're an investor, you're looking to flip, you're looking to do buy, renovate, refinance, buy and hold, repositioning, it's extremely hard to get money.
Mm-hmm. Yeah. Are you the only broker that is doing this? Because I've never heard of anyone else doing it.
We're the first to bring this to Canada, yeah.
That's really cool.
Yeah.
What made you think of doing this? Like, what made you take the step towards creating this and bring this as an option to Canadians?
Our clients, right? Our clients are looking to diversify, but also seeing the sentiment about investing in Canada change because of all of the things that have compounded with respect to the tenancy rules and the taxation and changing guidelines. So that's why I'm bringing it.
Cool. There's a lot involved when it comes to investing in the U.S. So you've got to set up, your corporations. You've got to do all these things on the back end. Is that something you would be helping people do as well, or is it just the financing?
So we're going to be tackling the financing, but through the relationships I established, we're able to connect investors with tax advisors, tax accountants, local realtors, local property managers. Mm-hmm. It's more of a concierge service. So because we do understand the hurdles to decision making investing in a foreign market, right? Yeah. So yes, that will be an extension of our services there through the relationships that we have.
Do you have specific markets that you're going to be targeting at first, where you've already established your realtors and your property managers and all that?
I did not establish the property managers and the realtors. It's through the partnerships that we have. They've got their diligence completed, and we've interviewed these relationships. Our offering is going to be across all 50 states, but where I'm seeing a lot of interest right now are particularly in Texas, Florida, Atlanta. Mm-hmm. There is one more, I can't remember now, but these are the states where I'm seeing a lot of interest, but our offer is available across pretty much 50 states. Yeah,
I would, including
California.
Right. I was just going to say, I don't know who would want to invest in California, because it's probably just the same as Ontario.
Yes, and the numbers don't work.
Yeah. Okay. Yeah. Well, that's really cool. Is there anything else you can share about this new endeavor?
Just very quickly, a rundown of the key things that are coming through. Like I said, across 50 states, the qualification is based on the income of the property, available to investors who are doing different investment strategies, including student rentals, Airbnb, flips, buy and hold, you name it. Very light on documentation when it comes to what's needed from a borrower. Yep. We would consider Canadian credit. And excited to share the details further when we launch.
Do you have multiple lenders?
Yes.
Okay.
Over 150 lenders.
Oh, wow. So how did you establish these relationships with the lenders?
Well, we have, I've had some relationships in the U.S. just because I have some mentors in the U.S. who I mentor with, and one thing led to another, an introduction, then opened up a door, and then I ended up getting introduced to some really great people there that helped me, connect the bridge.
Mm-hmm. Cool. Okay, last question.
Yeah.
I've got, let's say, a home equity line of credit here, Canadian funds. I want to buy something in the U.S. I would have to open up, let's say you connect me with a lender, and I want to work with that lender. Then I would open up a bank account with them. Is that how it would work? And then I would start transferring money, converting it from Canadian to U.S. currency?
Okay, so first of all, we have relationships to help you open up the bank account. Through the lending programs we're bringing, we don't need you to move money into the U.S. We just need to show that you have the money here in Canada. It's from legitimate sources. And then when the time comes to actually do the deal, we're going to need to move the money over. So yes, we would help enable a relationship to help you open up a bank account there. The other thing too is that we do pre-approvals. Some investors don't know what they don't know. They don't know how is this going to work, right? So we're able to pre-approve somebody, sit down, have a conversation today, look at their finances and say, okay, here is what you can be pre-approved for on the US side. Here are what the numbers are going to look like. We give them a letter. So when they're going there to put in offers, that strengthens their position as well.
Mm-hmm. Okay. That sounds exciting because even like I hear people talking all the time on the podcast about investing in the US and they're really excited about getting into the market, and it makes me think too, but then I think, well, there's so much I would have to learn and study and research to figure out how to get there. So having this as an option makes it so much easier. That's already like half the job is done for me, right?
Yeah.
So that's really cool that you've started doing that. Now on sort of a related note, investing outside of the province, that's another thing that you're seeing, right? There's more interest in Alberta, and do you want to tell us a little bit about that?
Yeah, so investors are always looking for cash flow, and in Ontario right now, with the higher interest rates, it's harder to find turnkey cash flowing properties unless you're buying a student rental or you're doing a rent to own or you're adding additional suites, right? So a value add strategy. But on a turnkey basis, investors can still cash flow at today's rates in other provinces because the prices are lower. So we're seeing activity in Alberta, Saskatchewan, Nova Scotia, New Brunswick, these are turnkey that are cash flowing.
Yeah.
So we're seeing a little bit of that right now.
I'd say, just from my experience, again, from the podcast, maybe 2-3 years ago, so many people were talking about Nova Scotia, New Brunswick. Everybody was excited. Then all of a sudden, nobody's interested and nobody's talking about that anymore. Now everybody's talking about Alberta or Edmonton, whatever. Are you still seeing people that are interested in the East?
Alberta, I'm seeing a lot of residential happen there. The other provinces, more multifamily.
Okay. Yeah. Yeah. So that's interesting too. Again, you can work. So you're able to work with the top banks here in Ontario and then get sort of the financing done for other provinces, or do you have to have like more of a local branch out there?
No, we're licensed now across 5 or 6 provinces: Ontario, Nova Scotia, Alberta, BC, Saskatchewan, and Manitoba.
Can you just give us a brief overview of the process if somebody is looking to buy outside of the province from a financing
perspective? It's exactly the same process as if they're buying here. So basically, they reach to us and then we run the numbers, validate their assumptions, and if they need a lender, we talk about how we're going to place the deal, or if they want to go through a planning discussion before even entering a market, it's the same thing.
Yeah.
It doesn't change anything because it's out of province.
Okay. And what % of your business do you project will be for people buying in either the US or out of the province?
That's a tough question. I don't know. I don't know the answer yet. The US is a very new topic. I see the potential. I see a lot of talk about it. But investing from a distance is a completely different game compared to investing locally. So there are investors who want to do it, excited about doing it. Will they actually do it? I don't know, but that's why I recognize these hurdles, and I'm bringing services to help them get informed about these local markets. How much business? It's too early to tell.
Right.
Too early to tell.
Are you hoping it'll be a big portion of your business?
Absolutely.
Yeah.
Absolutely. Yeah.
Okay.
I'm personally looking to invest there myself.
Mm-hmm. Multifamily or single family Airbnbs?
Probably both. I mean, the price per door and multifamily there is much better than here. But again, it's the same fundamentals of investing apply regardless of where you go. You got to understand the macroeconomics of the market, the taxation rules, the landlord rules, do the diligence at a neighborhood level, property level. All of these things we still have to zoom into to hit the ground, right? So,
yeah.
but I'm gonna definitely be investing there. I'm in the process of exploring this.
Cool. That way you'll have some experience so you can help everyone else, right?
Yeah, and I'm a big believer of that, right? It's important to, for me, it's important to bring real life knowledge and experience to the conversation. So I can be the guinea pig.
Yeah. Awesome. Let's go on to the next topic, unless there's anything else you wanted to add there. Okay.
No, I think we're good.
All right. Let's talk about the people that are in commercial multifamily right now.
Yes.
So we've talked about this before, but it's always good to get like a different perspective from different, I guess, people. So let's say somebody bought a building, they've got private financing, or they have a VTB, vendor take back mortgage, that sort of thing, and they're looking to go into a CMHC insured loan. What are you recommending people do? Because a lot of people, I mean, one of the main options would be to go conventional. So go to like a regular commercial lender, 25-year AM. The rates are going to be a little bit higher. It's going to be a little tougher to do that. You might not be able to get all the money out that you put in. You might have to dish in some more money, that sort of thing. So what other options do people have?
Okay, so before I talk about the options, let's just shed some context around what's happening with CMHC and this particular topic. So CMHC over the past 2 years has come up with new rules with respect to equity takeouts on multifamily properties. And the two important ones that really made it more challenging to switch to CMHC from a private loan or any other loan are, number one, CMHC said, we will not pay out any lender that is not on our approved list. So if you were to go on Google and look for the CMHC approved lenders, if the lender's name is not on that list, CMHC is saying, no, I'm not paying them out.
Yeah.
That's rule number one. Then recently they came up with another rule saying, if you're looking to take out equity, we also want to make sure that you have stayed with a CMHC approved lender for at least 2 years. Okay. So if you have an investor that bought a multifamily building to reposition it, they took a vendor take back and they took a private mortgage, and their idea was, I'm going to improve the condition, enhance the rents, increase the value and the cash flow, and I'm then going to go to CMHC, refinance it and pay off this loan. That is no longer the case. So some investors are facing this challenge right now. So what are some of the options? I'm seeing CMHC give exceptions, okay, on very few cases where, let's say, the investor added units. If the investor added units, created housing, which is what CMHC wants to see, they want to see more housing. So if the investor converted a commercial to a residential, okay, now they created housing. If an investor built something from the ground up, now they've created housing. If they added extra units, now they've created housing. There are certain things that are passing through, but let's say they just did a pure renovation, repositioned the building. That is now where people are getting stuck. So what are the options? Now we have to say, okay, let's look at the typical loan, which is conventional, which is a 25-year AM loan. And if you run the numbers, often you're not going to get enough on a conventional loan to pay off, a highly leveraged asset if the investor took high leverage. The other option is to look at what's called bridge loans. Bridge loans are interest-only loans. They're more expensive than a conventional loan. A conventional loan is with a bank, with a credit union. Typically, it's principal and interest payment. A bridge loan is an interest-only loan at prime plus 2, prime plus 3. And some lenders are giving exceptions on the debt coverage. So they're okay replacing a VTB and a private mortgage with a bridge loan, and let's say work with a debt coverage on the building of 0.7. Okay? Now, they're going to charge for it. They're going to deduct interest to make sure they're getting paid because the building is not covering all their all expenses at these rates. But that is an option to go to.
Can I just ask you a quick question on that?
Yeah.
So is that a valid option if you've already turned over a big chunk of the units? Like you get a VTB and then you put a lot of work into the building, you turn over, let's say 80% of the building. Can you still go get a bridge loan and get that 0.7 DCR given that there isn't that much lift left in the building?
It's all dependent on how the numbers play out, the net operating income, right? If you've already turned around a big percentage, right, you should technically be able to support the loan. But if there is a shortage, all I'm saying is that they're willing to work with that shortage. But you're paying prime plus with these lenders. They're CMHC approved. We can go to them and clear these loans for a year and try again with CMHC, but that's the bridge option to going, to dealing with the situation right now. And in some cases, George, clients are still running into a shortage. So you may have taken a big loan and you're hoping to exit with CMHC MLI, which is a common program right now. And if you run the numbers under a CMHC MLI on a 50-year amortization, the building will qualify for a very different loan compared to a bridge or compared to conventional. So what do you do when there is a shortage now? Well, with some of these lenders, we're able to keep a second mortgage on the property. They're giving exceptions to keep a second mortgage on the property. And in other cases, you'll have to find either another source of money to offset some of these shortages or bring in a partner, to an equity partner to the deal. So different ways. Is it simple? No. Is it solvable? Yes, but not a simple solution to the problem right now.
This is probably an unusual situation, but I'm wondering if you've ever come across it. Have you ever seen a VTB in first position during a refinance flip to a second position?
Yes.
You have seen that?
Yes.
Okay. Can you give us an example and what you saw?
Yes. So let's say the client has a really good vendor take back in place, right? Excellent terms, and they want to continue to utilize that, but now switch from that big vendor take back to a traditional loan. We can push the vendor take back to a second position, but here's how it works. Number one, the lender that we're going to has to allow it. Not every lender does. Number two, the numbers have to work. So we sometimes have to cut down that vendor take back from, let's say, 500,000 to 200,000, because the building has to demonstrate that it can still carry the debt load between the first and the second mortgage. And we've pushed vendor take backs to 85% behind a first lender, as long as these two things hold.
Like the total loan to value is 85%. Yeah. Okay.
Conventional lenders.
So then the person or the company carrying that vendor take back, they would have to approve the changes, right? So like in that example, it would go from 500,000 in first down to 200,000 in second.
Yes.
Do they just have to advise their lawyers that they're willing to move forward with it, or what procedure would happen there?
You mean the owner of the building or the lender?
No, the lender that's providing the VTB. Because the terms are changing, right? It's going from a first to a second, and it's a smaller amount.
Okay, so let's differentiate. Let's clarify the word lender. There is the traditional lender that is giving the big mortgage, right? An institution, and then there is the seller / original lender that gave the vendor take back. So you're asking about the second, right?
Yes.
They will have to draft a new agreement, right, with you as a borrower, and the lawyer has to register that smaller loan in second position. It's really like a private second mortgage. Yeah,
because I've heard of people in the past that will include a clause in their original agreement of purchase and sale, which states that they are allowed to transfer the VTB from first to second, basically without the seller's approval, right? Have you ever come across something like that?
I haven't come across that one. No. No.
So that would be interesting. But that could be a good option, because I believe that CMHC will allow, in some situations, a vendor take back in second position, right?
Yes, CMHC allows second mortgages behind them as long as the debt coverage holds. But you have to always think about what's the exit for that VTB or second mortgage down the road, right?
Yeah. Okay, so there's a lot to process. And then also on a new purchase, let's say you're looking at purchasing a building and the seller is willing to do a VTB in second. Can you take that and go straight to CMHC in that situation?
Keeping a VTB second up to 100% loan to value?
No, let's say up to 80% or 85%.
Yes, as long as the building can support it on a purchase, we can.
Which is
but
odd.
on a payout, on a equity takeout payout, they wouldn't pay out a VTB.
They won't pay it out, but they'll allow you to have it on an initial purchase.
Yes.
which is so unusual.
Yes.
And then what DCR would you be looking at in total in that situation?
Well, depends on the program, right? So under their regular housing program, generally anywhere from 1.25 to 1.3, depending on the number of units.
Okay. And do you have any sort of, can you share what some of your clients have been doing to qualify for the MLI Select program? Like what's been the most effective and kind of cost-effective way to qualify for that?
So new construction is easy, right? New construction, they typically go with the energy efficiency play on new construction and are able to hit 100 points on energy efficiency, and they may combine it with accessibility if they're building something from the ground up.
An entire building or just an extra unit or two?
No, if they're building 5 units or more, right?
Okay.
Like construction.
Yep.
They're building a new asset and it's easy to build it with clean, a more efficient energy setup. If it's an existing asset that is being repositioned, I'm seeing affordability, or let's say you're buying something. Affordability is a big category depending on the market you're in. And then we combine it with energy efficiency. Typically, it's hard to get to 100 points on an existing asset, but you can still earn some points on energy efficiency and combine it with affordability to get to, the maximum number of points. Right. Accessibility, I am not seeing it as often compared to these two categories.
Yeah, okay.
Yeah.
So let's say you're building an extra unit or 2 or 3 inside of an existing building, then what you can do is, let's say you've got some bachelor units, you might be able to qualify for affordability there, depending on the size of the unit. And then if you put heat pumps in and that sort of thing, then that might push you into whatever the category of MLI Select. Maybe not the full 100 points, but you might qualify for a lower tier.
Exactly.
Yeah, and that's what most people you're saying are doing, right?
Yes.
Okay, great. Any other tips? So, yeah, anything else here? We talked about bridge loans. That seems like the best way right now, right? To kind of exit out of that, or as we said, doing a combination of a bridge loan plus converting that first position VTB to potentially a second to help reduce your overall costs, right?
That's right.
Yeah.
That's right.
Anything else?
Since we're talking about commercial, one thing that I know is working well for investors right now is taking a residential asset and converting it into a 5 or a 6 units or more, right?
You're talking about like a single family?
Yeah. And really building on site, densification of the site, or adding units or a combination. We can use commercial construction financing for that type of deal, and then exit with CMHC under any of their programs, because we're adding units.
Can you talk a little bit about commercial financing, what that looks like? And let's say, okay, let's give an example. You have that single family home. It's in a zone that allows you to go to 5 units, and maybe you put a garden suite as well or something like that. What would the kind of commercial financing look like? So
there are two types of commercial loans that we can utilize with a CMHC exit. We either go to a CMHC approved lender and ask for commercial construction financing. So basically they would give you what's called a bundle loan. A loan to acquire the current site. That loan can go up to 75 or 80% of the as-is value, and a loan to fund the construction, which can range anywhere from 75% to 100% of the construction budget. How far they go, there are multiple factors that play into that, but at the end of the day, we want to make sure whatever you're building, if you're going to end up with 6 units or 7 units, we want to make sure that whatever loan that end product qualifies for is big enough to pay off the loan that we're taking upfront to acquire the asset and renovate it, okay? These are prime plus loans, prime plus 2, prime plus 2 point something, interest only loans during the construction, and then we basically roll them into a CMHC loan once the project is complete, okay? That's one option. The other option is to start from the get-go with a CMHC construction loan, which would offer a much higher loan to value. Like under the MLI program, we can go up to 95% loan to cost. So let's say you're buying a site for $1 million and your construction is going to be, I don't know, $3 million, so $4 million. So technically, we can go up to 95% of that $4 million. Of course, we have to deconstruct it down to what loan are you going to get on closing, what fees are involved. But these are cheaper loans. Instead of being prime plus 2, they're much cheaper. And they roll into a CMHC exit a lot more smoothly because you're starting from the get-go with CMHC. But they're a little bit more bureaucratic.
There's so many different options here, and actually it sounds like there's some really good ones for people listening. But if we do go back to that construction financing that you mentioned, so let's say you have an existing building and you are looking to add units there, can you use the construction financing in that situation, even if there's private financing in first position on it?
Yes, you can use construction financing, but when the deal closes, right, on the day of closing, the day of funding, the lender will have to pay off that private, replace it with a new loan to get the construction going.
At what point here are you talking about? Before you begin construction?
Before you begin, yes, before you begin.
So can you say that again? I didn't catch it.
So you're looking to, you already have an asset that's got private money on it, and you have a plan to bring it up to 8 units, 7 units, right?
Yeah, you're adding 1 unit, let's say. Yeah.
We're really doing construction financing now on that asset, whether you're using a CMHC approved lender or through CMHC. To answer your question, will that private get paid out? Yes, because that is not an equity takeout. We're bringing in money to transform that asset into something that CMHC cares about.
Right, but let's just say you're not taking it to a CMHC insured loan later. Let's just say you wanted to just do the construction, right, and then go with a bridge loan. Is it first of all, is that construction loan registered on title or no?
Yes, of course.
It is registered.
Yes.
So then it would have to go in second position potentially, right?
They have to pay off the private.
You have to pay it out.
The construction lender would want to take first position.
Okay.
And then advance the construction money.
But let's say the construction cost is $150,000.
Yes.
And you have a private for $2 million. How would that work in that situation?
So you have a private for $2 million. The construction is $150,000. What's the value of the asset today?
Let's say 2.5.
2.5. Okay. Yeah. So we're looking at a total cost of 2.5 plus 150,000. So how can we structure a loan to pay off the existing $2 million private, okay, and give you as much as possible to do that construction is what we're solving for here.
Okay. So then that might be a bridge loan in that situation, right? That might be the way to do it. Just get like a large bridge to do the construction and then look to refinance it later.
It's a bundle loan at Prime Plus, so you can call it a bridge, but it does have a construction piece to it, right? Because there is a piece of the loan to pay off the existing lien, and then there is another piece to fund the construction. But yes, it's priced similar to a bridge.
And then the amount from the construction, is that paid as you submit invoices, right? Like as you start doing the work, then you get a little portion here, a little portion there.
Construction draws, yes, with the 10% hold back on the construction liens.
Right. And let's say, just to give another example, let's say you had Desjardins in first position. You have a conventional commercial. It's okay. Conventional commercial mortgage there, and you wanted to get construction financing in addition. Is that a different scenario, or it would be the same thing where you'd have to pay out that first?
It depends on what we're looking to do, right? If you're just looking for a small construction loan of $100,000, it doesn't make sense to go and replace the first position and do a big construction loan, right? Maybe you just get a second mortgage and finish the construction and we refinance after. But we have to be careful about demolishing an existing asset. If, let's say, Desjardins is in first position, maybe they're not going to allow that. It can backfire. So this is why, depending on what you're looking to do, if you're just adding a unit, that's different than demolishing the asset. If you're demolishing the asset, you typically have to pay off the existing lender and get a proper loan in place.
Sure.
If you're adding units or renovating units, we can supplement with, secondary financing, depending again on the size of the loan we're talking about.
Okay. Good to know. So there's a lot of creativity, a lot of different ways to get around things. Are you seeing, like, this is kind of not a very nice question to ask, but I'm just curious, are you seeing that a lot of people that have these private firsts that are kind of in trouble now and they're scrambling, trying to figure out how to get through it? Or was that a few months ago and now people are in a better position?
There is a lot of scrambling and trouble going on with private money.
Yeah. It's unfortunate.
Yeah, it's very unfortunate.
Yeah.
Again, sometimes it's at no one's fault other than the environment has changed. The rules have changed, midway. So people have to figure out new ways to exit these loans. We're in an environment where private lenders have become more conservative. Even commercial lenders have become more selective. CMHC tightened up the rules. So we're at this stage where there is high pressure on many fronts in the lending and real estate space. It's temporary. It's going to ease up, but we're in that phase right now.
Yeah, when the prime rate, I think the lowest point in the last 3 years was 2.75, I think.
Yeah,
something
2
like that.
Something. Yeah.
Yeah, like that was the lowest. And at that point, private money was like 4.99% for a
remember
first,
these days?
Yeah, like 75% loan to value or something, right?
Even higher.
Yeah.
There was private money on the street at 100% loan to value. I'm not a big fan of that approach, but yeah, that money existed.
Yeah, and it was not that high, really, the rate to get that kind of money. So things have changed a lot. Like what's a private first, let's say 80% loan to value going for roughly? I know it depends on credit rating and the person's profile and all that, but roughly what would somebody be looking at?
Anywhere from 7 point something to 9 point something right now.
Yeah. Okay.
With, at least 2% in lender fees.
2% lender fees. And then B lenders right now, similar 80% loan to value. I think they're in the like high sixes to maybe 7-8%.
Yeah, in the sevens roughly. And the B lenders are selective about the markets they lend in. They're not going to go 80% on every market. They generally do 75, but in select markets, they're doing 80.
And then some of them are offering 35-year M's, right?
Yes.
Yeah.
Yes.
So that helps a little bit with cash flow.
Yeah.
And then on the A side, what are we looking at?
You're looking at rates in the fives right now.
In the fives for a 5-year fixed?
For a 3, for a 2.
Is this like personally owned primary residence?
Yeah. Rentals, you would add a small premium to that.
Yeah. Holdco add another premium?
Yes.
Yeah. Okay.
Canadian thinking versus American thinking.
Yeah. Okay. And then the last thing we want to touch on would have been the OSFI regulations. So the changes there.
Yes.
If you can kind of give a brief
regulations,
overview on the changes that are coming.
Yes, we need more regulations because things are very liberal in terms of lending rules here, and we need more regulation. Okay. All right. So here's what's going on. OSFI is the regulator that regulates financial institutions. That's the A lenders, the B lenders. Credit unions are not regulated by OSFI. OSFI is always concerned about consumer debt, and this is the rationale behind why these rules keep coming, right? So when the rates were really low, they introduced the stress test, and it actually served us Canadians really well in the sense that when the rates went up, you would have expected defaults to be all over the street, and that's not the case, right? It's because these qualifications happen under the stress test rules to protect everybody. So that served us well. Now, the expectation is that the rates are going to come down. So OSFI is saying, okay, when the rates come down, we don't want to expose the system to big additional debt. And they said, we want to come up with a rule that will limit the bank's ability to lend on what they call riskier deals. So what is a riskier deal under this new rule that is called the loan to income? They're saying that financial institutions, every quarter, you guys got to make sure that whomever you're lending to at a portfolio level, you're not exceeding, if we look at all of your loans, you're not exceeding 4.5 times the income ratio to a mortgage. Debt to income. So
across
your portfolio as a bank. So this is happening at a bank level. It's not or a financial institution level. It's not like your GDS and TDS ratios when you go qualify for a mortgage and the lender says, okay, George, what's your income? What's your debt? And do you fall within this ratio, that ratio? It's not happening at an individual file level. It's limiting financial institutions from growing beyond a certain point when it comes to mortgage portfolios. So what does this all translate to at the end of the day to us, on a day-to-day basis? The headline is more tightening in terms of lending. Mm-hmm. That's what it's going to boil down to. So my interpretation is that what it would do for clients who own multiple properties or are looking to acquire multiple properties, because that's going to impact the debt to income ratio, is either you're going to go to the lender and the lender is going to say, hey, this is a riskier deal. Now we're going to charge you more, or we're going to cut down the loan amount, or go to the next lender, and that next lender may be expensive. Mm-hmm. So that's my interpretation. Maybe on paper, the deal qualifies, no problem, because that bank would do 10 rentals. The numbers work beautifully, but because they have now that higher limit, it may impact transactions or conversations in that fashion, increasing the cost of money to investors, unfortunately. Mm-hmm. Mm-hmm. Yeah. So what should you do about it? Well, I always say change is change, and what we can do is be proactive and be ahead of the change. So if you have an opportunity right now to set up secured line of credits on equity in your portfolio, do it. It's money that you may not need right now, but you may need later, but you don't want to be in a position where when things tighten, you can't access it. So do it. Planning is more important than ever. How can we maximize what we can do now with each lender more strategically, even given the impacts on the lender? So it's all about planning and being proactive with also setting up equity through secured line of credits, in my view. So that's how I see it. Yeah,
it's just one more kind of hurdle just from personal experience. Every single time I've had to refinance a property, I've had to there's always been hurdles and obstacles. It's never been easy. There's always been let's figure out a way to make this work, right? Exactly. Now it's just one more thing that you have to do. Exactly. Right. And on that note of secured lines of credit, do you have any lenders in mind that can go behind a first, an A lender in first position, that sort of thing, that isn't going to charge an astronomical rate? The B lenders go behind the A lenders, but they charge for it. They charge 10+%, right? Yes, yeah, right now. Which might not be that bad compared to certain other options, but just one thing for people to consider as well. Okay, so I think that's it. Was there anything else you feel like we should touch on? No, I think we've covered a lot. We're definitely in a tighter lending environment and in an interesting environment when it comes to real estate. But I always say, don't get caught up in the noise and the negativity, and focus on buying assets in good
locations, hold them for the long term. And yes, the rates are high, but if the numbers work, the numbers work. And despite the tighter regulations, there is always a way, there is always a solution. It doesn't mean that it's simple and easy, but we all are going to continue to build our wealth and, acquire properties as an asset class. So it's really, at the end of the day, not a showstopper, and it's just a phase that we're all going through right now. And cycles, right? Cycles.
Yeah, exactly. Well, I think most people, when they come out of this cycle here, they're just going to be better. They're going to be better investors. Their portfolios are going to be better. So it's going to lead to good things, but there's probably some pain to be felt right now.
Yes, it's like being in the gym, carrying these weights, and it's painful, and we're cursing while we're carrying these weights, but we know we're going to be, much stronger coming out of it.
Yeah, Dalia, as always, thank you.
My pleasure.
I appreciate that you're optimistic, and you're always looking for ways to change your business and to look at the next thing. So thank you for all that, and looking forward to staying in touch.
George, thank you very much.
Thanks for listening to this episode. Your support is truly appreciated. And if you can share this with a friend or family member that might benefit from the information, remember, our goal is to motivate and inspire others to take action and to build wealth and to become well off. Enjoy the rest of your day.